Hey guys, welcome back to one more interesting session where we try to decode a terminology or a concept based upon financial modeling valuations or equity research. So, core concepts of investment banking, or financial modeling valuations or equity research. So, if you believe I'm adding value to you, to your knowledge, to the content by which I'm sharing that via the YouTube channel, please follow, subscribe, and press the bell icon to get updated for the continuous videos and the updates on this channel. So, in this session, we shall be speaking specifically about the cost of capital, simply the cost of capital or the weighted average cost of capital. The cost of capital is also called as the weighted average cost of capital. It is also called as the overall cost of capital. The session might be lengthy, but after the session, I can make sure that you guys will be able to understand each and every integrity of the cost of equity, the cost of debt, and the cost of capital as well. Now, cost of capital is something which is a very critical input in the field of financial modeling and valuation. When you do a DCF modeling, discounted cash flow model, you need to discount the future free cash flows by an interest rate or a discount rate. So that discount rate is nothing but the cost of capital. And that cost of capital is nothing but the weighted average cost of capital. So firstly, we'll try to understand कि what exactly is the weighted average cost of capital, exactly होता क्या है, हम कैसे इसको कैलकुलेट करते हैं, what nuances can be there in the calculation of the weighted average cost of capital, what mistakes we as students tend to do, or we as the financial analyst in a specific company tend to do while calculating the weighted average cost of capital. Now the thing is, specifically, if we try to understand the weighted average cost of capital होता क्या है, simply understand this as a discount rate. And that rate is very crucial in discounting the future free cash flows of the firm. It can be free cash flow to the firm, it can be free cash flows to the equity, right? So both the difference we have talked about in the previous sessions. You guys can go through my YouTube videos. You'll be finding a clear-cut difference in the cash flows, the FCFF and the FCFE. But very broadly, if we talk about the weighted average cost of capital, it is simply the discount rate by which you are discounting your future projected cash flows, not the actual cash flows, but the future projected cash flows. So, whenever we talk about the company's value or the company's intrinsic value, right, or the company's fundamental value, so what exactly is the intrinsic value of a company? The intrinsic value of the company is the most basic fundamental value of a company. It takes into account the company's cash flows, the profits, right, ROEs, ROCs, and basically it tells you the value of the company at which its shares should trade in the market. Now, based upon that, we can judge that whether the company is undervalued or overvalued. Okay. So, our intrinsic value is the most basic fundamental value of a company, broadly based upon the future free cash flows. So, if somebody asks you in the corporate interview that what exactly is the value of a company, the value of the company is the intrinsic value. It simply states the current state of the company plus the present value of the future cash flows, discounted at the cost of capital or the interest rate or the discount factor. Because whatever value you see, you go to NSE or a BSE, you go to your stockbroker's app to purchase a company's share. And what price the company is trading in this market is the summation of the current state plus the present value of the future free cash flows. If you go for a high growth company or a company which is quite decently growing, much of the value shall be commanded from the future free cash flows and not from the current state. So many of the high growth companies. Now, high growth companies you might find much in the mid cap spaces or the small cap spaces. So many of these high growth companies, much of the value or much of their intrinsic value is coming from the future free cash flows and not from the current value. Now, the allocation, it might be like 60 to 70% of the value is coming from the future, and thus 20 to 30% of the value is coming from the present state of the business or the current state, right? उस कंपनी की वैल्यू ज्यादा प्रपोर्शन में कंपनी के फ्यूचर की वजह से आ रही है इंस्टेड ऑफ द कंपनीज प्रेजेंट वैल्यू सो दैट्स द मोस्ट सिंपलेस्ट सेंस but to calculate that intrinsic value we need to calculate something called as the cost of capital, the weighted average cost of capital. So the weighted average cost of capital or simply the cost of capital or the overall cost of capital is simply the discount rate by which you are discounting your future free cash flows. Now, this weighted average cost of capital, it simply denotes the riskiness of that cash flows. Because whenever we are talking about the company's valuations, okay, a company ka valuation is always impacted by three factors. Company's valuations is always impacted by three factors. Like one is the cash flows, It can be the free cash flows to firm or the free cash flows to equity, FCFF or FCFE, discount rate. Now, this discount rate is nothing but the weighted average cost of capital or simply the cost of capital. And then you have the growth rate. These three important metrics that tend to define the company's intrinsic value, the company's present state, as well as the company's future state, based upon the which we are trying to calculate the company's fundamental value or the intrinsic value. So these three parameters are something we need to be quite ascertained about, right? The way we are trying to project the company's future free cash flows, the way we are trying to calculate the company's discount rate, the way we are trying to calculate or assume the company's growth rate is something which is very critical. Assumptions upon these should be clear cut. आप जो भी नंबर यहाँ पे कैलकुलेट कर रहे हो या जो भी नंबर आप एज्यूम कर रहे हो, दैट शुड बी क्लियर कट, राइट? Now, when I am calculating or when I am trying to value a company based upon the company's future free cash flows and discount rate and growth rate, the numbers which I take for my financial model, it might be different from some other person's financial model. He might be using different values for cash flows based upon his future assumptions because financial modeling valuation is completely based upon assumptions and forecasting. So my assumption might be different from your assumption. Discount rate might be different because this is representing the riskiness of the cash flows or the riskiness of the business, that how much risk is possessed in those cash flows, which I am discounting. Again, that risk or the nature of that risk or the assumption of that risk in terms of value or the quantitative factor, it might differ from person to person. A person preparing or calculating the discount rate or the cash flows at JP Morgan, his number might be different from a person calculating at the Morgan Stanley or at the Motilal Oswal Asset Management, right? Right. Then you have the growth rate. Again, the assumption for the growth rate can also be different. By how much growth the cash flows of the company shall be growing in the future and also at the terminal value, in which we tend to assume a steady growth state of business. So again, these things are very critical, and the calculations of this, it might differ from you and me, but you need to have a rationale for the same. Till the point of time you are having a rationale or a reason that why this number has been taken for the cash flows or discount rate or the growth, you are completely right. But if you are just copy pasting the numbers from Google or ChatGPT or from some other analyst, and you do not know the rationale for that, that why these numbers have been taken in the quantitative terms, you are absolutely wrong. So you need to have a complete justification और रीजन कि भाई आप ये numbers ले रहे हो तो क्यों ले रहे हो? अगर डिस्काउंट रेट 10% है तो क्यों है? अगर कैश फ्लोज आर ग्रोइंग बाय 10% and not 12%, why 10% and not 12%? So you need to have reasons for that and rationale for that. And that is something which is very important and crucial to understand. Now, if somebody simply asks me, right, कि discount rate क्या होता है? It is simply the riskiness of the cash flows, right? The discount rate is a connotation for risk. It's a proxy for riskiness in my cash flows, how risky my cash flows are. It tends to take into account different factors, right? Your cost of capital is derived from two major costs. One is the cost of equity, and the second is the cost of debt. One is the cost of equity, and the second is the cost of debt. These two tend to give you the weighted average cost of capital. Without this, you cannot calculate the weighted average cost of capital. Or simply, we can also say, in the most simplest sense, that whenever we talk about the company's capital structure, a company's capital structure is composed of two types of contributions. One is equity and second is debt. The preference shares become part of equity only. And in debt, you have the long-term debt and not the short-term debt. So debt and equity broadly, they tend to comprise the company's capital structure. Now, if somebody is contributing or investing into your company via equity, he expects certain percentage of return upon his investment. So for example, if I'm investing 100 rupees into the business and I invest 10% upon my investment, a 10% return, 10% ka munafa on my investment, that 10% simply becomes my expected return upon my equity investment. Expected return and not the actual return. Actual return can be different or will be different than the expected return. And simply for the right, the I would say the kind of debt portion also, right? If somebody has granted debt to my business, I have taken loan, my business has taken loan from HDFC Bank or ICICI Bank or raised money via the fixed income securities using bonds or debentures, then I'm entitled to pay them a certain interest payment. That interest payment becomes the expected return upon that fixed income security, right? So there are two contributors, one from an equity perspective and one from an debt perspective. So both the people expect certain kind of returns upon their investment. One can be basis upon equity and one can be basis upon debt. And when you combine both the expectations in terms of equity and debt, you get something as the cost of capital. So cost of capital is simply telling you the expected return that the total capital contributors will make from their investment. The expected return that both the equity holders and the debt holders will make or are expected to make from their investment. Expected cost of capital, expected return that both the debt holders as well as the equity holders will make from their investment. Again, expected and not actual, right? So simply, if we want to calculate the cost of capital, firstly, we need to calculate the cost of equity and cost of debt. Cost of debt is simple to calculate. You just need to copy paste the numbers mostly. But in terms of cost of equity is something that we have to calculate. So when we are trying to calculate the cost of equity, so cost of equity is simply it pertains to our equity investment. If an equity holder or a person who has contributed equity as an investment into a business, he expects certain kind of return. That's the cost of equity. So for example, if me as a retail person wants to purchase some shares of an X company, I go to Zerodha's app, I go to Grow's app, I place the purchase order, I get that shares into my Demat account. Now, for example, if I purchase that share at 100 bucks and I'm expecting the share would rise by 10% or 12% or 13%. So that's my cost of equity. So that's my expectation. Again, it is into my parlance. But when I have to calculate that cost of equity, various factors are involved. That 12% number, 13% number is just a layman interpretation. That's my kind of basic expectation, and 12%, 13% I want from the market. But from a financial point of view, an equity research point of view, a financial modeling valuation point of view, I need to calculate the cost of equity in a much more professional manner, decent manner, and clear manner. So to calculate the cost of equity, I simply use something called as a capital asset pricing model, CAPA model. Now, CAPA model is the only model by which you can calculate the cost of equity. Now, there have been certain kind of abbreviations, or I would say certain kind of improvements of these models based upon multi-factor, three-factor, or like four-factor model. But 100% of the people in the market tend to use CAPM because that's the most simplest to understand, was direct to calculate and easy to calculate, right? And this will give you the most appropriate number also. Now, what exactly is the CAPA model? What exactly is the capital asset pricing model? So one thing we know, as we discussed a second back, that CAPM is used to calculate the cost of equity. But if in the interview somebody asks me कि भाई CAPA model होता क्या है, तो वहां पर I can't simply say that the CAPA model is used to calculate the cost of equity. The interviewer also knows he wants a technical definition. So there, what I can answer is that the capital asset pricing model or the CAPA model, it tries to establish an equilibrium relationship or a relationship between the cost of equity and the systematic risk. It tries to establish an equilibrium relationship or a simple relationship between the cost of equity that I want to calculate for my business and the systematic risk. What is systematic risk? I will tell you. Systematic risk is beta. As of now, systematic risk is beta. So we're trying to establish an equilibrium relationship or a relationship between the cost of equity and beta. ठीक है, तो ये हमारा बात सॉर्ट हो गई है. अब if we just try to understand from a formula perspective, now cost of equity is denoted by KE, right? It says RF plus beta into RM minus RF. RF plus beta into RM minus RF. Now cost of equity is equal to the risk-free rate. RF stands for the risk-free rate. B stands for beta, and RM minus RF is the equity risk premium. The difference of RM minus RF, this whole bracket, it gives you the equity risk premium. Now let's try to decode each of these parameters. So cost of equity we know क्या होता है. Now basically we have to learn that how to calculate the cost of equity. The risk-free rate. The risk-free rate is the interest rate or the yield you get upon a safer security bond. Now, a safer security, fixed income security, can be a government bond, a government bill, a treasury note, which is backed up by the government of a specific country. Because it is assumed that the governments of strong countries or stable countries will not default. Though the governments of many countries have defaulted as well, right? Like we had like some scenarios of Denmark or the Argentina in the past. But majorly, strong, stable countries will not default. And that is why investing into a government security, be it via a government bond, a treasury bill, a treasury note, right, gives you a risk-free rate. The assumption is the government will not default. The fixed income securities are absolutely risk free. Now, every government might have a tendency to default also. अगर हम सिंपल सोचें, ठीक है, बिकॉज बेसिकली हम बोल रहे हैं कि द स्टेबल गवर्नमेंट्स विल नॉट डिफॉल्ट, राइट? बट एवरी कंट्री शुड हैव अ 0.00001% रिस्क ऑफ डिफॉल्टिंग, कुछ तो होगा ही. अगेन दैट इज टेकन इन टू अकाउंट while the calculation of the risk free rate, right? And that we'll talk about how. Now the risk free rate will be a smaller number as compared to the expected return upon equity. Why? Because the basic principle of finance or corporate finance, higher the risk, higher is the expected return, and vice versa. Lower the risk, lower is the expected return. So, since you are taking lower risk in the market while investing into a government fixed income security, which is backed up by the government of India per se, and it will not default. So, hence, you are getting a lower interest rate on that, a lower yield on that, right? But when you go towards equity markets, you invest into equities, you buy companies' shares, or simply go towards investing into Nifty 50 or a Nifty 150 mid cap fund or a small cap fund, the expectation of your return is simply higher or much higher versus investing into a risk free rate, right? Now, here in terms of the risk free rate, we tend to take basically a 10-year bond yield. Usually, we tend to take a 10-year bond yield. We do not take a 2-year bond yield, 1-year bond yield, 6-month bond yield, because that is a very short duration bond yield or a shorter maturity bond yield. We generally tend to take a longer duration bond yield because over a 10-year period, much of the fluctuations in the economy tend to get averaged out. And also, a 10-year bond yield is also an indicator, or this long-term bond yield is also an indicator or a proxy for the country's long-term growth rate. Because this financial modeling and valuation exercise is done for long term. We are doing investing. We aren't doing trading. हम शॉर्ट टर्म स्कैल्पिंग या स्विंग ट्रेडिंग नहीं कर रहे हैं कि आज स्टॉक को बेच के हम आज स्टॉक को खरीद के हम बेच रहे हैं. This financial modeling is prepared only for investment purposes. We recommend people to invest into such stocks or such themes or such sectors for long term investment and not for trading reasons. And that is also the reason that a long term bond yield, it tends to represent the long term growth rate of the economy as well. And that is also the reason that why we take into account a 10-year bond yield only, a longer maturity bond yield. Now, the bond might be risk free, or I would simply try to clarify the government bond might be risk free. But agreed, the bond will not be having a default risk, right? The bond might not be having a credit risk also, right? Because the payment will be done on time on maturity. But two types of risk will always be there, right? Be it a corporate bond, be it a government bond per se. There might be some price risk and reinvestment risk. Price risk and reinvestment risk. So there's a concept called in the fixed income market, though it's out of purview, but that's for your just for the sake of your understanding. There's a concept called as duration in fixed income. It talks about the inverse relationship between the price of the fixed income security and the yield commanded upon the fixed income security. So when the interest rates in the market are high, the price of the fixed income securities in the market will be low. And when the interest rates in the market are low, the price of the fixed income securities in the market will be high, right? So an inverse relationship between the price of the fixed income securities and the yield commanded upon that fixed income security. So when the yield is high, the price of these bonds might face losses because they will face mark to market losses because the yields are rising and the price of the bonds will come down. But when the yields fall, the investor is getting a lesser yield in terms of return, but the price of the bond has risen, right? So there is always an kind of an opportunity cost, right? Either you get a higher yield with a lower price or a higher price with a lower yield. So many of the fund managers tend to strategize, like I would say, like buying like such kind of positions by trying to hedge the portfolios against long durations and short duration strategies. So these kinds of like duration hedging strategies are there. But to keep that aside for this discussion, just to make it simple, every kind of a bond in the market will always face a price risk or a reinvestment risk. The credit risk or the default risk might be zero or will be zero for the stable government bond, stable government backed bonds. But the price risk or the reinvestment risk might always be there. Price risk in terms of the fall in price when the interest rates rise because of the inverse relationship between the price of the fixed income securities and yield via this concept of duration. And the reinvestment risk is that when we make money, we might not be able to invest the proceeds, reinvest that proceeds at a similar higher rate. Till that particular point of time, the interest rates might have come down in the market, right? So the reinvestment risk might be there at a lower yield. Now, it is very important to adjust this risk-free rate. इस रिस्क फ्री रेट को एडजस्ट करना बहुत इंपॉर्टेंट है, right, against the probability of that default, because every country, be it the strongest country of the economy, because if you see the world's strongest economy, US, is facing the problems of default. The debt is $40 trillion. They're servicing more than $1 trillion just in interest every year. So if such kind of economies have the chance of defaulting or the probability of defaulting, then any country can default or any country can face problems, right? So we need to adjust this risk-free rate by something called as a default spread. We need to adjust the risk-free rate by something called as the default spread. So for example, if the risk-free rate in India currently, if we take a 10-year bond yield, ठीक है, तो 10-year bond yield का कितना risk-free rate है, right? So if I just go to here, right, correct. So 10-year bond yield का कितना risk-free rate है? So simply if I just go to the 10-year bond yield, I say India 10-year bond yield. I can just simply go to Google. मैं आपको दिखा भी देता हूँ मैंने कैसे निकाला है. India 10-year bond yield. I will simply type India 10-year bond yield. When I type, I can go to like any of the websites. All the websites will give me a same number. Investingindia.com, I like completely really try to rely upon this website because the numbers are much more closer to the actual estimates. 7%. ठीक है. So that 7% का number is the current bond yield. 7% का number is the current bond yield in India. So 7% का number I can just take up here. Now I need to subtract that default spread. I need to subtract the probability of that default, right? So how can I subtract the probability of that default in terms of the risk-free rate? From where I can get that default spread. The default spread is simply the probability by which, in the quantitative terms, that this bond might default, correct? So I need to subtract that number. So usually for that, we tend to look at Mr. Ashwath Damodaram's country default spreads and risk premium report. Right? So Mr. Ashwath Damodaram is the most well-recognized professor in the field of financial modeling, valuations, and equity research. He's a valuation guru. Big companies like JP Morgan or a Morgan Stanley, they tend to use data from this file. Now, this link is updated as of January 5th, like 2026. So many of the YouTubers or like many of the analysts in the market, they tend to rely upon this data. So यहाँ पे you get the Moody's rating for the different countries. You have the adjusted default spread. You need not worry that how this number has been calculated. Okay. Your default spread would simply be what? If I just tell you in the most simplest sense, the yield on a corporate bond or the rate of return upon a corporate bond minus the rate of return you get upon a government security. Because a corporate bond will be having a higher default probability because the company can't default versus the government's probability of defaulting. So that, for example, if you get a 10% yield on a corporate bond, because a corporate bond is much more riskier, a 10% minus 7% for the risk-free rate of, right? The risk-free rate of the government is 7%. So 10% on the corporate bond minus the risk-free rate commanded upon the government security per se. So a 10% minus 7%, 3% becomes the adjusted default spread. Broadly, I'm telling. These numbers can also be taken from the overnight swaps. They can be taken from the rating organizations also. But broadly, this table is giving you these numbers already calculated. So यहाँ पे if I see the adjusted default spread and if I just go to India, this is again in the alphabetical order. India कहाँ है? ये रहा India. It is 1.87. So 1.87 becomes my adjusted default spread. So this number of 1.87, I can simply take it to my Excel, right? So if I just say my default spread in this case, my default spread in this case was 1.87, or I can just simply go in here, right? I can just add one line. I can just type default spread, or I can just simply type India default spread. The 7% का number I have updated. ठीक है, ये number मैंने यहाँ से ले लिया. ठीक है, तो कितना नंबर था? आई फॉरगॉट, इट वाज 1.87। हाँ, 1.87%। सो 1.87%, right? I can again insert one more line. Again, this is the adjustment which really people do in the market. They will just take the 7% and calculate. But I'm giving you the most precise calculation that how to calculate that. Now, if I just take an adjusted risk-free rate or the actual risk-free rate or the closest risk-free rate, it is simply of 7% minus, sorry, it is just 7% minus 1.87%. So 5.13 is my adjusted risk-free rate. And again, this number shall be used in the calculation of the cost of equity in the CAPA model. So one thing we got to know, the risk-free rate needs to be calculated and adjusted with the default spread always. Always we need to do it. Okay, to get a much more, I would say, a realistic estimate. Okay. अब the risk-free rate is clear. For all of those who are still tuned in this session, I guess we have surpassed a couple of minutes. Thank you so much for that. And if you believe I'm providing genuine value, please subscribe and press the bell icon. Now we have beta. Now, beta is a measure of systematic risk or a proxy for systematic risk. Now, there are always two types of risk. One is the systematic risk and the other is the unsystematic risk. Let's try to understand the unsystematic risk. Let's try to understand, or I'll just draw in here. Just a second. I just go in here. I go to insert and go to data. Okay. So maybe I'll just type in here unsystematic risk. Unsystematic risk is also called as diversifiable risk. The risk which I can diversify. And how I can diversify the risk? I can diversify the risk by simply creating a portfolio, right? The risk which you can diversify by creating a portfolio is the systematic risk. So for example, if in a recent time, if I had just invested into the IT companies, and we all know that what has happened with the large cap Indian IT companies, like even the mid cap and the small cap IT companies also, they have been facing issues due to the attack from AI, right? The AI threat is there because our companies aren't able to evolve as quick as the US companies or the South Korean companies or the Taiwanese companies per se or the Chinese companies per se. Now, many of the stocks or all of the stocks have corrected by some 30-40% odd. So if someone had just invested into the IT companies, his portfolio at this particular point of time would have been completely negative. Like he would be sitting into losses, losses, and losses. But if somebody had also invested into PSU banks or metals, a bit of healthcare, right? Defense, capital goods, power, all these sectors, all these themes gave you enormous return of more than 20-30% in the past 1 year. His portfolio will still be positive. Now, this risk you have diversified away by creating a portfolio. Now, this risk which you have diversified away is called as unsystematic risk. This risk can simply be diversified away by creating a portfolio. Then you have the systematic risk, that is your beta. Now, beta is also called as a market risk. It is that risk which you cannot diversify by creating a portfolio, right? Now, this unsystematic risk or a diversifiable risk is also called as a unique risk or a company specific risk because based upon company factors, you add stocks, you remove stocks, and try to balance the portfolios. Try to add good stocks, try to add like good positive outlooking stocks, and try to negate the negative stocks. But in case of systematic risk, it's not company specific, it's market specific. There might be some geopolitical tensions, there might be some wars, there might be some tsunamis, there might be some depression or a recessionary kind of a scenario. In these particular circumstances, even a strong company might face correction because the overall economy will crash or correct a lot. And even the fundamentally strong companies, the large cap companies, might also face correction. And that is something we need to understand, right? So it is completely market linked. You cannot diversify this risk by even creating a portfolio. And that's what beta is. How to calculate beta, we'll talk about it. Uh, then you have the equity risk premium. You are multiplying this by the difference of the return on market. RM is the return on market, and that is Nifty 50's return, the index ka return, not a stock specific return. Here you cannot take a Nifty 150 mid cap or a 250 small cap ka index. You have to take the broad based index that tends to represent the Indian economy, and that's Nifty 50. The barometer of the Indian economy is Nifty 50. So Nifty 50 will take up here. The Nifty 50's 10-year average CAGR. Broadly, we tend to prefer a 10-year average CAGR because we are taking a 10-year bond yield. Over long terms, even the Nifty price fluctuations or the return fluctuations also tend to average out. It might give you somewhere between like 11.5% to 12% 10-year CAGR over different time frames, or even on a rolling basis also. Right? But still, we'll calculate that. How to do? We'll take that into account. And again, RF is the risk-free rate. Now, the difference between the return on the market and the risk-free rate is the equity risk premium. It means it is simply the premium that you are paying to invest into the equity markets and not investing into the risk-free rate, because you are taking higher risk to take or get higher return. The premium that you are paying to invest into the equity market at the index level and not at the risk-free rate, which is backed up by the government securities or the government of India per se, for example. ठीक है. अब now we'll go to this tab at the RM tab. Now here I've taken the data, right, of past 10 years just to update this data, right? This is the updated data, right, which I've taken up here. ये निफ्टी 50 का 10 साल का डेटा है फ्रॉम 31st May 2016 to 31st May 2026. हाउ टू गेट दिस डेटा? अगेन इट्स अ प्रॉब्लम. यार ये डेटा हम कहाँ से निकालेंगे? नाउ अगेन दिस डेटा कैन सिंपली बी फाउंड आउट फ्रॉम investing.com ओनली. आई गो टू investing.com. मैं यहाँ पे जाऊँगा. ठीक है. यहाँ पे आपको निफ्टी 50 का भी रिटर्न मिल जाएगा. तो इफ और सिंपली I can go to the NSE website also. I can go to the BSE website also, right, and find the returns. बट यहाँ पे अगर मैं लिख दूँ सीधा निफ्टी 50 क्लोजिंग डेली प्राइस डेटा, लाइक फॉर एग्जाम्पल, तो लाइक investing.com में आई कैन गो सिंपली एंड यहाँ पे आई कैन सिंपली जस्ट चेंज द डेट्स. ठीक है, मुझे बिकॉज आई वॉन्ट द डेली रिटर्न. तो यहाँ पे मेरे पास ये 2026 है. आई कैन जस्ट गेट द डेटा फॉर 2016. सॉरी, 31st May 2016, right? No, it's not changed. Can just go back to 2016. I can just change it and I can apply. So here you have the stream of data. It is loading. It will take a bit of time. ये देखो load हो गया सारा data. And here I can simply, and this is the price like which I want. This price is the closing price. I click on download and I will get this data. It will get downloaded as a CSV. ठीक है, आपका ये CSV में, इट्स ओपनिंग CSV, आपका CSV में होगा डाउनलोड. आई कैन जस्ट सिंपली कॉपी द होल डेटा कंट्रोल C करके एंड आई कैन जस्ट कॉपी करके आई कैन जस्ट पेस्ट इट हियर. आई कैन जस्ट सिंपली पेस्ट इट हियर. ठीक है. नाउ व्हाट आई कैन डू इज इफ आई जस्ट गो बैक टू investing.com, I can even change from the oldest date to the newest date, because यहाँ पे I'm getting from the newest date. Technically, I want the data from the oldest date to the newest date. So I can just filter it by clicking at this. See, because I get from the oldest date to the newest date, and I can just simply download. My data will be extracted from 2016 to 2026 instead of 2026 to 2016. और since मैंने यहाँ पे कर ही लिया है, I can just simply do also one more thing. I can simply just select it. मैं like select कर सकता हूँ. I can select करके I can just simply go to home. I have this option for sort and filter. I can sort from the newest to oldest. अगर मैं newest to oldest करूँगा तो 16 17. I can sort from the oldest to newest. Then like 26 से start हो जाएगा. But I want from 16 to 26. This column I can delete as of now. Right. And यहाँ पे what I can do, I can simply calculate the percentage change on daily basis. Right. For that, I can use it. I'll just zoom in for you. And just simply do the final value divided by the beginning value minus 1. The final value divided by the beginning value minus 1. Maybe I did some mistake. Is equal to final value divided by the beginning value minus 1. Why it's not giving me a percentage change? some issue maybe. Just a second. Deleted this column of volume because मुझे उसकी need नहीं है. And I can just do final value divided by beginning value minus 1. And I can just simply drag it down. I can just go down, तो मेरा data है, control shift upwards, control D. I simply get the daily return. I simply get the daily return, right? Percentage change in the daily return. अब यहाँ पे if you see in the RM market calculation, ठीक है, what we have done is I can just simply update the data and take the latest available data there, right? So what I can do is I have simply updated this data. So this data I have just copy pasted. मैंने यहाँ पे dates copy कर दी हैं. Dates पूरा copy करके I have just pasted in the dates and I have taken the closing price. ठीक है, open high low close से मुझे मतलब नहीं honestly because I was just need the closing price. ठीक है, and based upon the closing price I can calculate, right? So what is the value as on the end date? My end date is what? My end date is 2026 का date, right? So I can just simply go down. I can just take the last में कितना value आया है as on 29th, right? तो last working day रहा है. It is 23,547. I took it here. The value as on the start date is this, correct? My time period. How much is my time period? For 10 years I've taken, right? I've taken the time period 10 years because मैं 10 साल के लिए निकाल रहा हूँ, right? So one way to calculate the CAGR is using the normal CAGR formula. Is using the normal CAGR formula, right? That is your final value divided by the beginning value to the power of 1 by 10 minus 1. Final value divided by the beginning value to the power of 1 by time period minus 1. Whole full-fledged formula लगा के. But the best way which I prefer is by using a formula called as RRI. RRI gives you the CAGR in Excel. RRI gives you the compounded annual growth rate in Excel. RRI. It says the number of payments per year. मतलब कि 10 साल का मैं निकाल रहा हूँ basically 10. My current value is 816. I started from 8160 and my future value became 23,548. So what's my CAGR? It gives me an exact same value 11.186. I can simply use this number as my return on market. Average 10-year CAGR for Nifty 50 has been almost 11%. 11%, just 11%, I would say, from 31st March 2016 to 31st March 2026. So that number I've taken up here. ठीक है. अब if I go to the weighted average cost of capital, this number has been taken up here automatically. It's taking up from the RM tab. ये number ले लिया है. Adjusted risk-free rate we have calculated already. Now it's time to calculate the cost of equity, right? But before that, beta. How to calculate beta, correct? So this is a listed company limited, again a hypothetical company. I'm not going stock specific. I've taken the data for past 10 years. I've taken the data for past 10 years from 16 to 26. Now similarly, I can take the data for Nifty 50 also for past 10 years or 5 years. यहाँ पे मैंने 5 साल का लिया डेटा. I can change these dates. I can change these dates from 16 to like 21, right? Or I can change this date from like 20 to like 25. I can change that data. ठीक है, but just to make you understand that how I have calculated that. Past 5 years का simply in the same manner, just download the Nifty index का data and that we all know that how to calculate. Right? वो आपको पता है that how to calculate that. Correct? Similarly, take the data for your target company. Take the data for your target company. अब यहाँ पे मैं निफ्टी 50 का भी फॉर एग्जाम्पल इफ आई जस्ट चेंज द डेटा जस्ट फॉर द सेक ऑफ अंडरस्टैंडिंग. Basically, just for your satisfaction, I have updated the data here also in the beta tab. I have taken the past 5 years Nifty index ka data. You know that how to pull it out. And this is again a hypothetical company's data for past 3 years. Again, I've calculated the percentage change in daily returns. Your final value divided by the beginning value minus 1, right? And here what I've done that is I've used an if error function. So the if this function simply tells me that if I will get an error, that for example, if my previous value is a higher value, right? In that case, my base will become a smaller number. And the output here might give me an error. It might give me a hash NA. It might give me like some kind of blank error per se. ठीक है, तो as for the purpose of the presentation or when I will calculate the beta, and if I get some hash NAs or some kind of errors here, the beta will not be calculated. So I've simply use an if error function as a simply calculator in front of you also. If error function is equal to if error. It says value. My value should be this number divided by this number minus 1. But if there is an error, if in case I get an error, if my previous value is I would say a smaller number, then either give me a 0 or give me blank. For blank, I can just put a double quote, space and double quote. I press enter and the same I've done here also and the same I've done here also. The question might come how to extract a company specific data. अगर आपको कंपनी स्पेसिफिक डेटा भी एक्सट्रैक्ट करना है, यू कैन सिंपली गो टू द बीएससी का वेबसाइट. बीएससी के वेबसाइट पे जाके यू हैव दिस ऑप्शन फॉर द मार्केट्स. यू क्लिक ऑन मार्केट्स, राइट. Under this equity section, you have this historical data. You click on historical data. You can get for indices also and get for individual shares also. I clicked upon equity. Here in the equity market capitalization, I want the historical stock prices. I clicked upon historical stock prices. Period, I want daily returns. I can enter the name of the security. So for example, if I wanted for Tata Steel, now again, no stock recommendation, only for education purpose. I clicked upon Tata Steel. I can select the date from this date to this date. So for example, if I want from 2016 9th of May से लेकर आज तक का मुझे चाहिए, I can just simply select the data and submit, right? And I can just simply get the data. मैं submit करूंगा, मेरे पास data आ जाएगा and I can simply get the historical data. ठीक है, तो equity में जाके, historical data में जाके, यहाँ पे equity में जाके, historical stock prices में जाके, you can get that data. ठीक है, तो उसमें कोई प्रॉब्लम नहीं होनी चाहिए. एंड यू कैन जस्ट सिंपली डाउनलोड द एक्सेल फाइल एंड कॉपी पेस्ट दैट देयर. I go back to the Excel file. Now here I have to calculate beta. Now ignore this D by E, ignore the unlevered levered beta. Here we are simply calculating a 5-year beta. And this beta is the levered beta. Now there are two types of beta. One is the levered beta and the second one is the unlevered beta. A levered beta will have the impact of debt into it, and unlevered beta will not have an impact of debt into it. The beta that we use in a CAPA model will always be a levered beta and never unlevered beta. Why? Because the cost of capital that you are getting while using this beta is representing the riskiness in the cash flows or the riskiness in the business. And the risk comes from leverage or debt, right? How to calculate that? I've simply used a function called as the slope function in Excel is equal to slope, and it will directly give you beta. It says known y and known x. Now y is taken here as a dependent variable and x is taken as an independent variable. For Y, I simply selected the daily changes in returns for the listed company, hypothetical company. Yeah? And for X, I simply took the changes, the percentage change in daily returns for Nifty 50. ये मैंने कर दिया. I selected these whole columns and I pressed enter, and here comes my beta. My 5 years levered beta is 0.14. Now, beta can be less than 1, it can be more than 1. If the beta is more than 1, it is an aggressive beta. If a beta is more than 1, it's an aggressive beta. If the beta is less than 1, it's a defensive beta. It's a defensive beta. For example, if my beta of the stock is 1.2, if the beta of the stock is 1.2, it means it will rise or fall much more than the index. Because beta is a proxy for systematic risk. You are comparing that how reactive or like what's the action or the movement of your stock vis-a-vis the market. Depending upon the market, how the stock moves. So stock becomes a dependent variable upon the movement of the market. Right? So for example, if my beta is 1.2 and that's more than 1, if the Nifty rises by 1%, my stock will rise by 1.2%. But अगर Nifty 1% से गिरेगा, मेरा stock 1.2% से गिरेगा, ज़्यादा गिरेगा. But if, for example, if my beta is less than 1, right? In this case, it's 0.14. It means if Nifty rises by 1%, my stock will rise less. If Nifty falls by 1%, my stock will fall less. So hence the fund managers technically tend to have a balanced portfolio, having a composition of both aggressive stocks and defensive stocks, which can handle the market volatility or the market movements. And that is something we need to understand. Okay, but in this case, it's a defensive beta. The beta is less than 1. The beta we have calculated. Then we can go to the WACC. ठीक है, अभी इसको आप इग्नोर करना कि भाई ये अनलीवर्ड बीटा कैसे निकाला है, फिर अनलीवर क्या करा है, टारगेट डी भाई ये क्या है। इट्स अ पार्ट ऑफ इक्विटी रिसर्च सेशंस। ठीक है, विल कम टू दैट लेटर सम टाइम। You guys can join my curriculums also for that. Now, the market rate of return is 11.19. Equity risk premium, it is 11.19 minus not 7%. Adjusted risk-free rate 6.06%. Beta is 0.14 or like 0.13 that we have taken. Cost of debt in this case, take as the cost of equity. Beta, so cost of equity हम कैसे निकालेंगे? How can the cost of equity be calculated? So cost of equity can simply be calculated as the risk-free rate plus beta into the equity risk premium. The cost of equity comes out to be 8%, 7.78%. Cost of debt, I've assumed that to be 8%. Tax rate, you need to adjust, right, the cost of debt with the tax rate. So for example, if I take a loan from HDFC and HDFC gives me a loan at a 10% interest rate, that 10% adjusted with my tax rate, 1 minus tax, it becomes my cost of debt. So 8%, and 25% is the tax rate. So cost of debt, I can simply calculate this as 8 into 1 minus 25%. 8 into 1 minus 25%, right? So that becomes my cost of debt. Now, how can I calculate my WACC? So assumingly, the formula for WACC क्या होता है? What is the formula for WACC? If I just go to the Word document, simply, or if I just tell you, it is your cost of equity into the weight of equity plus the cost of debt, which is denoted by KD, right, into the weight of debt into 1 minus taxation. This gives you the formula for the weighted average cost of equity. Cost of equity that we have calculated into the weight of equity, how much equity is there in the capital structure, plus the cost of debt into the weight of debt into 1 minus tax, right? So यहाँ पे if you see, for example, if the capital structure is 100%, 4% is debt and 96% is equity, my cost of debt is 6%. My cost of equity, I can take as 7.78%. मैंने यहाँ पे ले लिया. And my weighted average cost of capital, it comes out to be 7.71%. I can simply do a weight into cost and add this. Or also I can use a function called as sum product. Sum product. This and this. It again gives me a same answer. 7.71%. A sum product. I selected this column and this column without manually doing it. So here I get my weighted average cost of capital. Now, one important way or like one important thing that we need to understand as a part of equity risk premiums. Take it the weighted average cost of capital we have calculated, but let's try to understand more upon the equity risk premium. More upon the equity risk premium. ठीक है, अब हम equity risk premium की अगर हम बात करें, there is something called as a country risk premium. Again, this equity risk premium needs to be adjusted. And here we have not adjusted the equity risk premium. This equity risk premium pertains to the specific index. Okay, but when we are doing for a specific stock and we want to calculate the cost of equity, so this we have calculated the cost of equity, right? But if it pertains to a specific company, as in this case, and because this case may like we are trying to calculate for a specific company, right? So we need to adjust a country risk premium. We need to adjust something called as a country risk premium. So if we just go in here, this is the country risk premium file. It says the country risk premium is the additional return investors demand for investing into an emerging or developing market. कंपनी में तो आपको पैसा मिल ही रहा है, but what additional you can get while investing into that emerging country or a developing country per se, above and beyond what they would require from a stable market, mature market like US. Here the countries factor also come into place. Stock factor is there, but the country's factor also comes into place. So it says that when you value an Indian company, you are exposed to risks that simply don't exist when valuing a US company. So political instability, it might be some currency risk, regulatory uncertainty, weaker institutional frameworks. These add to odd risks. CRP captures that extra layer quantitatively, so it can be reflected in your discount rate. So the ERP for India is the mature market premium, the mature risk premium. So usually we'll take the developed economy here. The biggest developed economy is US. So US market का mature risk premium क्या है? And we add the India's country risk premium to it. And we add India's current country's risk premium to it. Right? Now it's a formula to calculate the CRP. I can share this file with you. Okay, and again it's for the like Mr. Ashwathamodaram's method. So you have the ratings, you get your default spread from that file only. Equity bond volatility ratio 1.52. Now here he has taken the standard deviation of an emerging equity index, it might be MSCI, divided by the standard deviation of an emerging bond index. You divide that, you get 1.52. CRP for India 2.85. Then how the CRP has been calculated? It's your default spread, right? It's your default spread into this 1.87 into 1.52. We do a 1.87 into 1.52, you get a 2.85. You add a US maturity equity risk premium to it, 4.23 plus 2.85. The equity risk premium for investing into Indian market from a lens of a foreigner, albeit an Indian also wants to invest into India and not just the foreigner market, is 7.08. Right? So basically, if I just go to the Excel file, right, your country risk premium, it is simply what? It is simply your default spread into the division of the standard deviation of emerging equity index divided by the standard deviation of emerging bond index. And when you do that, you get a country risk premium. Add this number, add this number to the matured risk premium of US, and you get something called as your total actual ERP. Total ERP for India. Okay. One thing also, what people tend to do is, for example, if I take a company X, अगर मैं कोई भी company X ले लूं, and I want to calculate the cost of equity for that. Assumingly the beta for that company is 0.57. Assume करो the beta for that company is 0.57. And by using this concept, I want to calculate the equity risk premium. I can simply take the risk-free rate. The risk-free rate here is 5.13%. I've taken that, right? Plus my beta is 0.57. My beta is 0.57. I can just open a bracket into what? Into what? If I just simply take a mature market equity premium, ठीक है मैं mature market equity premium ले लेता हूँ. The mature market equity premium in this case was how much is the mature market equity premium for US? US का कितना mature market equity premium है? Right? I can simply just take that. US का कितना? Let's check. Let's go to this file. इसी में चलते हैं Mr. Ashwath Damodaram's file. United States, is that the last? 4.46. 4.46. I will subtract my default spread from it. So 4.46 minus 0.23. 4.46 minus 0.43. So in this case, my MRP is equal to 4.46 minus 0.23. 4.23 becomes my adjusted MRP for US. Market risk premium for US is always the equity risk premium for US minus the default spread. Correct? ये हो गया. And the ERP for India. And what is the country risk premium for India? इंडिया का country risk premium कितना है? I can simply get from this file because यहाँ पे you have this option for also to calculate the country risk premium. इंडिया का country risk premium is 2.85. minus 1.87. Right? Should we adjust this kind of default spread here? If we do a 2.85, right? In this case, we shall not be subtracting 1.87. So it is already the country risk premium already calculated while taking into account the default spread. I explained you the formula for default spread here, right? For CRP, right? Default spread into the standard deviation for the emerging equity by the standard deviation of the emerging bond. तो इंक्लूड करके ही ये 2.85 आया है, राइट? इंक्लूड करके ही 2.85 आया यूएस का. आई हैड टू कैलकुलेट बिकॉज दैट्स माय बेस मार्केट. तो एक्चुअली माय कॉस्ट ऑफ इक्विटी in this case it simply becomes what? The risk free rate plus this beta into 4.23. I can just separate this in bracket and do not add 2.85 like this. If you add this, it shall be double counting, right? Because the country risk premium has been included already in the risk free rate also. तो हम डबल काउंटिंग नहीं कर सकते हैं. Separately, I can add this as 2.85. So once I do it, ठीक है. So here I've done C7 plus, एक second, the beta, simply this beta of 0.57 into the mature market equity risk premium, right? And I've simply added India's. So simply I have this 5.13 ka number with me, correct? So what I will do is my formula becomes the risk-free rate plus beta, right, into this market US premium number, MRP. So this will be calculated separately plus the CRP. I cannot add CRP to this bracket because it shall be double counting because RF already includes the country risk premium. It's already embedded into this number, right? So I have the risk-free rate with me, that is 5.13%. I can add this 2.41, which is a 0.57 into 4.23. It gives me 2.41. And adding this number, 2.85. Adding this number, maybe there is some error. Let me check. I give 10.39 as my cost of equity. The risk-free rate, which was 5.13, plus the beta into the mature market equity risk premium, plus the CRP of my country. Risk-free rate plus beta into the matured risk premium for US markets, and इसमें I've adjusted the default spread as well, plus the CRP. Because CRP anyways include the country's default spread, hence I have not deducted the country default spread again, plus CRP. It gives me a 10.39. The same exercise can be done here also. So this is how we can calculate the cost of capital by using the cost of equity, cost of debt, right? How to adjust the risk-free rate, how to adjust the equity risk premiums, right? By using the default spread and the CRP. The question might come is how can we get the cost of debt of a company? हम cost of debt कहाँ से निकालेंगे अगर हम किसी कंपनी का कैलकुलेट कर रहे हैं? So for example, if you want to calculate the cost of debt, आप कभी भी नोट्स टू अकाउंट्स में जाओगे ना. So for example, like it's a company. अब उसके नोट्स में जाओगे, फॉर एग्जाम्पल आई गो नोट्स टू द स्टैंड अलोन फाइनेंशियल स्टेटमेंट्स, लॉन्ग टर्म बोरोइंग्स में देखूंगा. सो यहाँ पे आई विल फाइंड माई कॉस्ट ऑफ डेट. द टर्म लोन्स फ्रॉम बैंक्स कैरिंग इंटरेस्ट रेट रेंजिंग फ्रॉम 9.5% to 10.5%. Vehicle loans have been taken at a rate 7.15% to 9.45%. So broadly, we can say the loans have been taken somewhere in the range of 7.15 to 10.5. 7.15 to 10.5 की रेंज में लोन्स लिए गए हैं, right? So what can be my cost of debt, right, in this scenario? I can take the average cost of debt 7.15 plus 10.50 by 2. You get 8.8. So 8.8 into 1 minus tax, right? This 8.8, corporate tax is usually 25% into 1 minus, okay, the tax rate. Or simply I can just do, just to make you understand, KD into 1 minus tax rate, which makes 8.825 into 1 minus 25%. That will give you the cost of debt. So again, that is something which can be done. And I can just simply modify this also. I can do a control C. I can go here. I can go to home. I can go to pay special, right? In pay special, I can go to paste special. I can divide this by 100, get okay, and then convert to percentage. I'll get 8.83. Then I can simply do an 8.83 into 1 minus this 25%. And I will get my cost of debt as 6.60. These are the adjustments that we have to do. This is how simply we have calculated the weighted average cost of capital. If you're liking this video, you learned something new, do not forget to subscribe and press the bell icon. It will keep me much more motivated to come up with more such videos. Thank you so much. See you in the next session.